Hi there. 15 costly mistakes you need to avoid when you are buying shares. Are you planning to buy shares in whichever stock market out there? If yes, this video is for you because a ton of investors out there do panic at the point of purchasing or even before. Yet, you just need to buy the right shares at the right time and for the right reason. That's what separates successful investors from everyone else. That's why I'm making this video for you. And by the way, these lessons are applicable whether you are investing 5,000 shillings or even 5 million. With that said, my name is Afagza Sifuna, and you are all much welcomed. The first mistake you can do is buying because everyone else is buying. This is the biggest mistake because it's typically called herd mentality in investing. Maybe someone posted on our WhatsApp group saying, buy this stock before it doubles. Suddenly, everyone is rushing to buy that particular stock. No one even pauses to ask, what does the company actually do? Is it profitable? Is it expensive? During every bull market out there, people chase whatever is moving. By the time the average investor buys, professional investors are already selling. Because the truth is that markets out there, the biggest investors are institutional investors who do these things professionally, full-time basis. That is why when people out there are saying this stock is hot, but they are ignoring the real stock price or even the history trend analysis of that particular stock. Ensure you do buy value, not just panicking and running to buy like everyone else. Then the second mistake is buying without understanding the underlying business. If you don't understand how a company makes money, don't buy it. Simple as that. Don't buy it. Can you explain in one sentence how does the company want to buy stock of generate profits? Who are its customers? What are the biggest risks that that company is in, individually and also in the sector? If you cannot explain that in a very simple way, you are probably gambling with your capital. For example, if you are buying stocks of a bank, you need to understand the loan status of a particular bank. Does that bank, for example, have lots of non-performing loans? The deposits, what kind of deposit does it take? Interest income that bank generates. If you're buying a cement company, you need to understand construction demands, okay? If you're buying a telecom company, you need to understand mobile money, data, voice revenue, you name it. Knowledge is power. And then the third mistake is ignoring financial statements. Guys, this is a very disastrous thing because many investors never read annual reports. Instead, they rely on social media, Facebook, Twitter, YouTube, and NSE from friends or even Telegram groups out there. The financial statements typically tell you everything you need to know about the health of a company. If you get your hands to a financial statement, what do you look at? Look at revenue of a company. Look at its net profit. Look at the debt status of a particular company. Look at the cash flow statements. Look at the dividend history. You know, if profits are, for example, falling every year, why are you buying in the first place? Because that's going to tell you the potential of you getting dividends or even that particular stock increasing in price is very minimum. And then the fourth mistake is looking only at the share price. Unfortunately, that is what most of the hobbyists and beginning investors out there do. They just look at the share price. They're like, this share is cheap. They are hearing people are saying buy and they jump to buy without really understanding things beyond the share price. Case in point, if, for example, you buy at 30 shillings and then the share price comes to 5 shillings, you're going to make a big loss, which is going to affect you. That is why you need to look at factors beyond the share price, not just the absolute value or even assume what people are saying out there. Understand growing profits of a company, understand the healthy dividend situation, understand if the company has low debt, which of these kind of dynamics work for you, because you want to purchase stocks or shares of a company which is healthy, not just you looking at the absolute value and saying, I want to buy this. And then the fifth mistake you can do is purchasing when you ignore the company's debt. Debt can destroy shareholders' value, especially when interest rates rise, and even so, a company get in a situation where it can't pay its debt. Ask yourself, how much does this company owe? Can it comfortably repay its loans? Does it generate enough cash flows to be able to cater for the loans? Too much debt can wipe out years of profit, and that's a fact. We've seen it even in different economies out there. That is why the healthy companies ensure they have ideal debt ratios to be able to survive even hard economic times, okay? And then the sixth mistake you can do is purchasing immediately there is good news. Here's something many beginners don't know. By the time good news reaches television, it's already reflected in the share price. Because the unfortunate thing is that, yes, we typically say the market auto adjusts and there's typically no information asymmetry. That is true because chances are by the time something is televised, already the savvy people who got their hands on the information have already acted on it. And as such, the share price will barely move. Immediately you do purchase. And if it does, it's because of panic buyers. That's why institutional investors will already be cashing out on directional betting or directional positioning in a particular stock by the time you get in. And then the seventh mistake you can do is investing money you'll need soon in shares. For example, money for rent, money for emergency fund, okay? Money for hospital, money for whichever other important thing out there, school fee, you name it. And that's so because unfortunately, stock fluctuate. Share prices do fluctuate and they don't care about you. They don't care about the source of money you did utilize to pump into the stock market. That is why you can put your money down, for example, they are hoping to gain, and then it's down 30%. It's going to affect you. And then the eighth mistake you can do while purchasing shares is not diversifying. Guys, putting all your money in one stock is very risky. Even good companies experience difficult years, and that is a fact. Instead, spread your investment across multiple shares or multiple stocks. For example, you could put some of your money in the banking sector. In case there are banks which you think you need to invest in, put some of your money in telecom companies. Put some of your money in insurance companies. Put some of your money in manufacturing, in energy, you name it. The key is to check, do your own analysis, pick different sectors you can invest in, and then build your portfolio. Because diversification does reduce risk greatly. Some will do positively, others might lose. At the end, you'll be on the positive side. And then the ninth mistake you can do is ignoring dividends. Many investors only focus on price appreciation, basically checking this share was trading at this particular price is increased or dropped. Imagine two investors, okay? Investor A owns a company paying consistent dividend. Investor B owns a speculative company paying nothing. After 10 years of investment, Investor A may have earned significant cash while still owning the shares of the company they invested in, while Investor B is going to be struggling because even unfortunately, maybe the shares will have dipped in price. That's why it's important to also consider dividends, okay? And then the 10th mistake you can do is trying to time the market. Nobody consistently buys at lowest price out there. Nobody consistently sells at highest price. Simply put, you can't beat the market through timing. Instead, invest gradually. This is typically called dollar cost averaging, or in Kenya, simply investing monthly. You can say, for example, regardless how the market is performing each and every month, you're going to be pumping 5,000 Kenya shillings or even 10K Kenya shillings. You put in the market, be sure over time, you got to realize returns in a long period of time, okay? And then the 11th mistake is following social media gurus blindly. Always ask yourself a simple question. Do they actually own stock? Or are they just promoting stocks they don't have know-how about? Are they licensed, or even so, do they have the qualification and understanding to speak about stock market? Are they paid to promote it? Because remember, someone else's risk tolerance isn't yours. People have different levels of risk. A number are risk takers, they go aggressively take up risks, others are risk averse. Ask yourself that question, okay? And then the 12th mistake you can do is ignoring valuation. Guys, even an amazing company can be a bad investment if you overpay. Buying quality at a ridiculous price reduces future returns. Always ask yourself a simple question. Is the company fairly valued compared to its earnings, compared to competitors, compared to its own history? And that's so because price matters, and also check the valuation to really understand what it means. Or are you jumping on a noise signal? And then the 13th mistake you can do is you selling too quickly. Many investors sell after making maybe 10%, then watch the stock rise even over 100%, maybe in months or years in. Please note, we are not talking about stock rising in days. And that's why patience is very important and a key strategy while you are investing in stocks. And then the 14th mistake is you panic selling during market crashes. I've seen a ton of people, even friends out there, panic sell and they end up losing on the biggest of opportunities. The fact is that markets are gonna crash, okay? And a falling price can actually create an opportunity. Successful investors do not panic. They review the business, not just price on the chart or even news out there. They review to understand the nitty-gritties, the fundamentals, before making a decision. And then the 15th mistake you can do is investing without a plan. Before buying any stock, answer a few of these questions. First of all, why are you buying? Okay? Secondly, how long will you hold a particular stock? Thirdly, when will you sell it? Okay? Fourth, are you investing for income? Are you investing for growth? Are you investing for retirement? Are you investing for your children's fund? Are you investing for whichever purpose out there? Ask yourself these best questions because they're going to assist you develop a plan for investment and assist you even have the discipline for you to be able to honor your plan. And a bonus point for you, my 7-point stock buying checklist is that I typically look at these things before I purchase any stock. First and foremost, ensure I have understanding of the business. Secondly, gain deep understanding of revenue growth in that particular sector and the business. Third, understand profit growth. Fourth, understand issues around debt. Okay. Fifth, understand how that particular business generates cash. Because remember, cash is king even to your shares increasing and getting dividend. Okay. Fifth, understanding management of a particular company. Is it a good management? Is it a disciplined management? Or they can fumble your investment? And sixth, am I comfortable holding that particular company for at least 5 years? Because as always, I champion investment for the long term as opposed to investing for the senses, for the emotions, to enjoy the price increase and decrease in short term. I consider all these things before I make investment decision. I'd like to hear from you. What do you typically consider before you buy stocks? Okay. And most importantly, as you are putting your money down in the stock market, are the tips I've shared with you useful? Comment down below in the comment section. Let's continue engaging. Cheers, guys, and you all stay safe.